I think there's a general fear that the industry will disappear in a few years' time. I'm not sure that's the case. Well, I very much hope it's not, because then there's very little M&A to do.
I noticed a lot of shadow AI happening, which is just like the old school days of shadow IT, right? And so consolidating that power into a somewhat of a speedboat.
The bigger question here, however, is the adoption of AI tools and how you go to market, deliver it, how you deliver your service.
A lot of the reasons people use staffing, as you know, is to mitigate risk, for compliance. It's not just the finding of the talent, right?
Marcus Sawyer. Welcome you to AI and Recruiting, the show where they break down how AI is transforming hiring, leadership, and the future of work. Expect real talk, smart tools, and bold conversations with the people shaping what's next. Let's get into it.
Thomas Kardos, how you doing?
I'm good, thank you. How are you, Marcus? Nice to see you.
Yeah, you too, you too. So you've been probably all around the world and back since our last conversation, right?
In a few different continents.
Yeah, amazing. Well, I know that our audience from the last discussion that we have are super excited to hear your updates around the market. So it seems like we've got some interesting, let's say, observations around the month of May. So I think we should probably just dive right into it.
Absolutely, with pleasure.
Okay, great. So what's one of the things that you've noticed that has evolved? We can maybe talk from the first quarter now going into the next quarter.
So I think most importantly, and I think encouragingly, we have seen share price performances starting to pick up. So if you had asked me a month ago, and I can't remember exactly when we spoke last time, but it's a bit more than a month ago, most of the large, also smaller publicly listed businesses were at a 10-year low.
Yeah.
And take any, US, UK, Germany, any jurisdiction. There are a few exceptions. We've seen a few exceptions to that rule, but most companies were at a 10-year low. That has, in the last few weeks, changed. So share prices have started to crawl up, not increase dramatically, but at least there is some positive momentum. And that is despite the Iran war, which of course is causing some concern, but it doesn't seem to have dented performances so far. So yeah, I think from a valuation perspective, things are looking up. Interesting observations in May, which is a trend that we've seen already, is that Europe is actually performing quite well compared to, APAC is top performer and has been.
Yep.
But traditionally, we've had US professional staffing, followed by US commercial staffing, followed by EU professional staffing and EU commercial staffing. And EU commercial staffing is actually doing relatively well compared to some others. Reason I'm not entirely sure why, but you've got some companies listed in Europe that don't follow the regular patterns. So that might be one explanation.
Yeah. Okay, let's pull this chart up actually, because I think it's interesting for folks to see. You had mentioned that the share prices had started to increase. What do you think the reason for that is? What's changed in the market in order to cause that?
So I think when I think back to the SIA Executive Forum in London a couple of months now ago, it's for the first time that SIA had forecast growth both for the current year and for next year. So we're talking 26 and 27. That was still a forecast. What we're seeing from some of our clients is that the underlying performances are actually better and are actually in line with or exceeding expectations, which means that there is a higher confidence in the company's ability to achieve their targets. And it's a psychological cycle. If you believe that it's going to go well, then people buy and invest, and that drives share prices. Whereas if you think things are going south, then people try to run. So
yeah,
I think there seems to be a positive momentum also operationally. Certainly, we know from a number of clients across various verticals in the US market that performances are up year on year, quarter on quarter. We see also in European markets that the downward trend has stopped. There is some growth in certain pockets. Asia is doing generally quite well. Japan is doing well. Middle East obviously is down at the moment.
Yeah. And if we double click on some of those verticals where we're starting to see growth or better performance, could we talk a little bit more about those verticals where we're starting to see the business pick up?
I think generally we see, interestingly, in the light industrial space, both in Europe and in the US, that seems to be a market that is benefiting from, America first in the US, Germany first in Germany, and equal or similar political philosophies. So there is an increasing demand domestically, which hasn't yet been caught up by any tariff impacts or anything like that. So at the moment, there's still an investment cycle. So light industrial seems to be doing well. There's investment into new warehousing. There's investment into data centers. All of that at this point still falls into the light industrial space. Life sciences is up. Semiconductor seems to be recovering. IT, and obviously the entire AI boom, not from an impact on the industry, but purely from job creation perspective. I think you have a monthly statistic of new jobs being created versus jobs being taken away. That is still positive, net positive. So we see that also in underlying performances. Defense clearly is still on the rise, and anything to do with that. And energy, away from oil and gas, but more into generally renewables and other energy sources.
So we're obviously talking about the current market status and maybe a little bit of a perspective on what happened last month, what happened last quarter, and what's going on today. Whenever I speak to CEOs of staffing firms, one of the things that I find is they're always trying to see round corners, like everybody is, right? And so I'm not going to ask you to make some huge predictions, but it's also difficult if you've got any business of any size to completely shift your focus. So thinking about that as a CEO, how would you react to this current market, or how do you find opportunities in this current space today?
I mean, I think that goes a step further. I think it's, people, I mean, the companies have their strength or have their vertical focuses, and especially the larger players tend to stick to what they know, unless there is a hugely upcoming sector vertical that they don't cover, in which case they just buy typically or hire a team. The bigger question here, however, is the adoption of AI tools and how you go to market, deliver it, how you deliver your service. And this is, I think, where the smaller to mid-sized businesses have a huge advantage compared to the Adecco, Randstad, and Manpowers, because they have such huge platforms. To implement anything on those will be a much more daring task, I would say, than for smaller or mid-sized, or even, they can be billion-plus international players, but presumably their setup will be somewhat simpler than any of the very large multinationals.
Yeah, we're seeing the same with our customers as we are enabling them to govern their AI agents and their workforce, because one of the things is if you're thinking about AI, then your team's thinking about it, and then somebody in a branch is also thinking about it. So I'm noticing a lot of shadow AI happening, which is just like the old school days of shadow IT, right? And so consolidating that power into a somewhat of a speedboat, if you like, more of a smaller organization, we're seeing a lot of wins, especially on the back office stuff, where there's so much operational leverage. I mean, we got a call the other day from a client and somebody had handed in their notice, as they do, and they're on the back office, and they literally called us like a staffing agency. Hey, is there an agent that we can replace with them? So we are the agent, and it's now ready to deploy within 2 days.
Yeah.
Right. And so we're starting to see that in our space, those that are thinking AI first, because their first thing isn't to necessarily replace that headcount. It's how can I grow faster with leveraging technology?
Yeah. Which I think is valid in every professional services business. You know, if I look at my own industry in banking, you know, if people leave, they are more likely to be replaced by AI than by other hires.
Yeah, it's funny. We were obviously having a conversation offline around some firms that are valuing our industry maybe in a way that is completely undervalued, in fact, because they don't see the size and the breadth, but it's very much similar to professional services. And we see it with the larger firms that have this SOW business.
Of course.
And the reason that they outsource some of their work to either the staffing firm or offshore is to reduce costs. And they're going to do that with agents as well, right?
Yeah, absolutely. And SOW, by the way, is a big driver. And there seems to be a convergence in how the end customers look at SOW versus staffing. And we've seen examples where it's the same purchasing person responsible for both pockets now.
Yeah. Oh, wow.
So I do think it is part of the industry, and I think it's a strongly growing part of the industry, and it's more a consulting type service. Therefore, you can charge higher rates. You have premium margins. You create a much more sticky relationship. So it follows on from the let's move from pure temp staffing to MSP. Let's move from perm to RPO. So it follows that. So except you give more added services, i.e. consulting type solutions.
Well, you've probably seen that the Frontier Labs have been investing in consulting recently. So OpenAI put aside $4 billion for acquisitions in consulting to integrate their solutions.
And of course, Amazon apparently is starting a recruiting business. So, you know, I think there's a lot of space to grow still.
Yeah, and how? So let's talk, I suppose, practically from the buyer's perspective. And what I've noticed, and maybe you tell me something completely different, is that a lot of the buyers are still within the industry. So if you're buying a staffing firm, you're probably in staffing somewhat and you understand it. So you're not buying from outside. So how are the buyers valuing businesses today? We talked about on the last conversation, you mentioned size matters. We talked about the fundamentals as well. Is there anything that you're noticing where buyers are saying, hey, this really must be true in order for you to get that multiple that you would like?
I think size continues to matter, and we see that even in the flyer that you shared earlier. We have statistics there. You know, large cap are generally valued higher than mid cap than small cap. So that will typically always be true at the moment. So firstly, we're seeing good M&A activity at the moment. So there's a really good window, companies coming to market and buyer interest.
Okay.
Private equity firms are starting to come back into the market as well, which means there is a larger pool of potential buyers and maybe more competition, which has a positive impact on valuation from a seller perspective, of course. I do think, however, that buyers are still very conscious and much more focused on what they're looking to acquire.
Okay.
And I think less willing to compromise if it doesn't really fit what it is that they're looking for. So I think they're less willing to compromise on specific criteria, whether that's the activity, whether that's the geography, whether that's the quality of the team, whether that's AI or tech enablement, understanding for what is to come. I think those are key parameters for buyers.
Yeah, and I think it would be good to double click on that as far as how a buyer is making a decision, and also the process that they're going through. So let's liken it to something that we will understand. It's like if you're buying a car, right? There was a time I had a Mercedes convertible. That time was no longer when I had my child, and I needed a different type of vehicle, right? And of course, it's completely different to buying a business, but I'm in the market for something. No matter how much I want that sports car, it's just not practical anymore.
Yeah.
How are buyers thinking about maybe filling the gaps that they have, whether that's from a specialism perspective or maybe geo standpoint?
I think I don't actually think much has changed there, because thankfully people have different objectives and different strategies. One thing is for sure, the US market remains an attractive place people want to enter if they're not already there and grow. We're seeing that some of the European markets are becoming more attractive again, or at least people are expressing a higher interest. Middle East had a little bit of an, upswing pre-Iran war, with NES buying Halion from T20, and I think there's quite a lot of movement in the Middle Eastern market, quite a lot of positioning, quite a lot of companies. Obviously, there's a lot of, ignore the war for a moment, there are a lot of infrastructure projects going on. There's a lot of investment going into the Middle East. That requires labor, that requires payrolling, employer of record, and all these services. And it also benefits the surrounding countries where you may have lower cost bases. So there's a lot of outsourcing happening. So, I think there's it's an attractive market generally, and I'm sure the market will recover there as well. You still have the large energy players who are very oil and gas focused, who are looking to move away to balance that out. You've got the tech and IT guys that are wanting to benefit from kind of the growth that is now coming and positioning within AI and specialties within that. And obviously this entire AI boom, just purely from a construction perspective.
Yeah.
As I mentioned earlier, data centers, and I know there's a lot of investment going in there. So skilled labor and all that is very much on the rise, which people are looking to consolidate on. Still a very fragmented market.
I think you hit on a really good point around energy in particular, right? So you've got energy pressure from multiple areas, like from the standpoint of AI and infrastructure, but just the war as well, and general energy consumption going up. So that feels to me like a market where people are constantly looking at new ways to innovate within energy, whether that is to optimize current energy or find new sources of energy. And some of the firms that I've been speaking to more recently, they're really trying to get ahead of the curve and figure out where are the next data centers going up? How can we provide that support? And that goes into what we talked about earlier, which was that consulting area, right? If you have the SOW or you have the mandate from the board, then you know where it's going to fall. You have at least a better idea than most, right?
Absolutely. So there's an outsourcing angle or a consulting angle to it. There's the pure manpower need to implement whatever it is that you want to implement. So, I think there is quite a lot of resilience in the sector, which I think for the last 2 years, especially financial investors, whether public or private, didn't necessarily see. I think there's a general fear that the industry will disappear in a few years' time. I'm not sure that's the case. Well, I very much hope it's not, because then there's very little M&A to do. But I think I think it's much more resilient than one thinks. Clearly, companies will need to position themselves. There is AI disruption, there is technological disruption, there is adoption of tools and delivery models that will change.
Yeah, I think for a lot of these big projects, some of them are multi-year, and what I've found is that when people are doing big things, they need a stable and reliable partner. And so you don't change your partner every week. Therefore, you're in a multi-year agreement. Staffing firms do have to evolve, absolutely, because the next time that agreement comes around, companies are going to want better pricing. They're going to want better models, depending on what that service is that you're delivering. But I think, to your point, if something is existing for a long period of time, not only existed, but been able to transform each time. So whether it was the job board era, it was the social media era, it was the tip era, the staffing firms transformed into something different. And a lot of the reasons people use staffing, as you know, is to mitigate risk. It's for compliance. It's not just the finding of the talent, right? And anybody listening to this who's in the industry will know that. And sometimes we have a hard time explaining that to those that are outside. And so if we're to, again, try and look around the corner for a CEO that's listening in and they're thinking, hey, at some point, maybe I want to sell my business. Well, you talked about this previously, which I thought was a really interesting point, which was don't dress up the business for somebody to buy it. Do whatever you would do as normal. And build a great company, and there's going to be an opportunity for you at some point to assess your options, right? Because you're building a great company. But I'm thinking practically over the next 12 to 24 months, what would you tell a CEO listening in of a staffing firm or the board to think about doing, generally speaking, to position themselves to be something that's interesting to not potential buyers, but just the market at large?
I mean, I think if you buy a business, you want there to be the ingredients for future growth, right? So we're currently working with one business that is very strong in one specific activity. And, buyers kind of natural question were, well, what's next? Where are you going next?
Right.
Because this is all about growth strategy, positioning, how achievable is it? And so you need to have an idea of how your company can develop and evolve, either within the activity or geography that you're in, or both, or in adjacent activities or geographies, depending on what is on what the right kind of strategy could be for you. I think that's important. I think deliveries, there's still a lot of companies that are nowhere with AI and technology. Right. I mean, it's on the one hand, you have some really very impressive technologies and tech-enabled delivery models, and on the other, you still have a lot of very traditional, old-fashioned, recruitment businesses. Which isn't to say that's a bad thing, but I think the leaders of these businesses need to think very hard how they can stay in the game or move ahead of the game, because that is clearly a shift that is happening.
Yeah, and we see it in the valuations, right? We were talking about the outlier. So maybe let's zoom in to this, and we'll see Recruit's valuation just for professional is $77 billion. Now, many people who are listening to this will know that they own Indeed, they own Glassdoor. So there's technology that's behind that. But I think, to your point earlier around light industrial coming back, that game is about speed, compliance as well. And there's a lot that AI can help with, right? So there's a relationship side, the human side that everyone needs to continue to do and develop and build their customers. But it's actually, we're finding it's fitting it in the right place.
Absolutely. I think if you go further down, you see on precedent transactions, I mean, there's one outlier there as well. And that's it's a tech business or a SaaS business or AI as a service business, which is the Thoma Bravo Dayforce deal. Which is a very high multiple. So that's more a tech multiple, right? You're looking more at revenues, at a revenue multiple rather than an EBITDA multiple, because people don't value businesses at 50 times EBITDA. People, if it's a software business or an AI as a service business or a tech business, you look at annual revenues and how recurring they are. In a business like yours, Marcus, as well, people will look at how sticky and how recurring is the revenue model, right? We've got now an increasing number of what I would call HR tech or AI-enabled tech sale mandates or growth financing mandates, and we are clearly trying to position them on a revenue multiple as opposed to an EBITDA multiple, right? But then you also see, for example, other businesses which fall into the professional staffing space or more specialized. They have form engineering or healthcare IT. You do get higher multiples. Blackstone take private of Technoprode, another Japanese player, large. Japan anyway is a quite highly valued market, so that's not surprising. So those are the businesses where you see higher multiples being paid for, as opposed to just general staffing multiples.
Yeah, it's interesting. I mean, for those listening in and maybe driving or walking somewhere, so Dayforce was acquired by Thoma Bravo, and their enterprise value is 12.5 billion, and the multiple was 6.8 on revenue, 6.8x, and EBITDA was 48.1. Whereas you can look at some of the other companies as well, and we're seeing around the average EBITDA multiples are anywhere between 9 and 12 on average, right? So there's a couple of 14s in there. And to your point, Thomas, it seems to me that we're saying the reasons behind this is because of the stickiness of the revenue, the enablement of technology, so your cost to serve and your cost to deliver may potentially be lower, and then just also having great fundamentals, right? Which I think most staffing firms have the opportunity to do as well.
Yeah. I mean, another way of looking at it is just if you look at the revenue multiples of that chart.
Yeah.
Right? 0.4, 1.7, 0.8, 0.3, 2.2, 0.9, 0.7, 6.8 is the outlier, 2.1, 0.6, 0. So you see that, normally businesses are typically, somewhere in the 0.5 to 1 times revenue, because they're not based on they're not based on revenue valuations. Your really old-fashioned classic, blue-collar staffing businesses used to be at 0.2, 0.3 times revenues. If you look at more professional staffing, you kind of get into the 1, 2, maybe 3, and then you've got but 2, 3 is already a tech valuation, I would say, more than a general staffing valuation.
Yeah, and look, not all revenue is equal, right? So we know in staffing that a lot of the revenue is considered the employees' salaries and wages.
Exactly.
Yeah, which is completely different to the margins. So it's the type of revenue and the margin. Maybe that's also something for us to think about moving forward. How do you ensure that you can increase your gross margin? Because I think if you increase that line, you get a better revenue multiple on that. Is
absolutely, and that's where SOW type work as part of the portfolio is very interesting. I know a company that over the last 2-3 years, they're privately owned, but they've really tripled their EBITDA with a relatively stable revenue base, simply because they've added a lot of SOW into that mix.
Yeah, I think one of the opportunities as well with SOW, and I think this is where I'm seeing it with technology, is to ensure that project is also sticky, or you can go on to the next one.
Exactly.
Because sometimes you get that one and done, you get that big hit, that adrenaline kind of that hits your number and everybody's doing high fives. But then the next quarter, you see a big dip, right? So it's trying to figure out how to also balance that with consistency. Amazing. Well, Thomas, we're now getting towards the close. I think we've covered good amount of ground, from the fact that the valuations are impacted very much by the structure of the business, the fundamentals, sticky revenue, making sure that you've got high gross margins. We're seeing a couple of outliers in the space. You're giving some fantastic advice just on what you should do in the next 12 to 24 months, really ensuring that you're positioning yourself strategically. We talked about data centers, we talked about energy, we talked about the war. Is there anything that you want to leave the audience with for this month's edition that might be worth knowing?
I think I'm hopeful that we're entering a couple of good years in the market, which means that hopefully performances will reflect that. I'm excited to see kind of companies rolling out their AI tools and AI recruiters and agents, and curious to learn how that will ultimately impact and shape the industry. But I think it will be for the better. And from a purely selfish perspective, we're here. We're looking for deals. We have deals on the go. We have buyers looking to buy. We have sellers looking to sell. There's a positive momentum, I would say, in the market.
Yeah, perfect. Yeah, if anybody's thinking about purchasing a firm in the space, you need to connect with Thomas and team. If you're looking at selling, it's the same thing. So do reach out. Also, from my standpoint, if you are thinking about how you can set your business up for success by leveraging your AI workforce, and you want to either build, you need to integrate, or govern your AI workers, please reach out to me directly. Happy to have a conversation and see how we can be helpful. And hope you found this interesting today. And looking forward to the next one, Thomas.
Yeah, and just maybe a note for everyone: on our website, you can download monthly. We update monthly this valuation flyer, so it's a downloadable publication.
Yeah, we'll make sure that this is shared in the comments as well, in the notes, so people can get access directly to it on your site as well. And they've got access to the link. Great information that the team within your organization spend time doing. So I would look out for it, and also look out for the next episode of the Valuation podcast. I think that's the new podcast we're going to call it now, right, Thomas?
Okay, sounds good.
All right, talk to you soon. Cheers.
All right.
If you got value from today's episode, share it with someone in your network, your team, your boss, or that recruiter still stuck in 2015. Be sure to follow the show so you never miss what's next in hiring and AI. Until next time.